So the way we do sales tax is we create an invoice. We select an item, right? Any item, service, inventory, non-inventory. And then we tell QuickBooks whether or not this is a taxable item or not. And usually you should have a drop down that gives you two options, tax and non-tax. Now I created an extra one called use tax, which I'll show you how that works later on. But generally speaking, you will only really have two of these. So I'm gonna just disable this one for a second, just to avoid any confusion. So I'll make this one inactive. So normally most people will have a drop down that says tax and non-tax, and that's it. You basically pick this item is taxable or this item is non-taxable. Now I don't really want to get into the details on what is taxable and what is not, but generally speaking, in Florida, if you sell a product to another person in Florida and the other person doesn't have a sales tax certificate to prove to you that they're a reseller, you must charge sales tax, period. Now, if you sell a service to anyone in Florida or outside of Florida, it doesn't really matter. It is a service. It is non-taxable. Now, there's a combination of things where maybe possibly you have a service and a product mixed together, and that's when the law gets a little bit complicated. So we're not going to get too much into the details of that. Maybe we'll have a different episode. Maybe we'll have Avalara bring, an Avalara lawyer and talk to us about all that. But we can't really get into the details of that, but that could happen. And there's also certain complexities where most states have a statewide range of a statewide sales tax, but then each county could have a different tax. So at the moment, we're assuming that this is a single state tax rate, and we're going to use it for this sale. So there's two ways to do it. So one is we pick all of our items that we're going to have taxable. We hit the drop down here to tell it yes, it's taxable, no, it's not taxable. And then down here in the bottom, we select the tax rate that we set up for that state. So in this particular case, we have Florida sales tax item that we selected for 6%, and that's $312 based on the 512, and that's how we calculate it. The other option is I actually have an item here that I called itemized, which is basically a non-taxable sales tax item. So I select this one called itemized, which is basically 0. And then I want to break down the sales tax inside the form itself. Now, that's not advisable. I believe it's much better presented when you have it all the way in the bottom. But there are cases in which the client wants to see that sales tax directly under the item. And if you're going to manage Surtax, or if you're going to have sales tax in different counties, that in itself could affect things. Okay, so it's actually either or. So you don't have to pick one in this case. So it's either we're going to do, on the line item itself, or we delete that and then we put it under the bottom. So it would be either or, right? So either one will track your sales tax. So there's my $312 in sales tax. I'm going to date this invoice for somewhere in January, and then I'm going to click Save and Close, and I'll hit yes. Then I'm going to go to the vendors menu. I'm going to click on sales tax, and then I'm going to click sales tax liability. And then I'm going to click on dates, and I'm going to click last month, and we're going to see exactly what's going on here. So according to this report, we had $5,200 in taxable sales. We had $0 in non-taxable sales. We collected $312 in taxes, and we have a sales tax payable of $312. Now, rule of thumb number one, the tax collected amount and the sales tax payable, if you're a monthly sales tax reporter, that should always be the exact same number. If you're a quarterly sales tax reporter and you're looking at, let's say, for example, February, then the sales tax collected will represent February, but then the sales tax payable should represent February and January, assuming that we're doing January to March. So the sales tax payable should always equal the total amount of sales tax that you will pay at the period that you pay, whether it's quarterly or monthly, and the tax collected represents the actual sales tax that is inside of invoices and sales receipts in QuickBooks for the period that we selected on the report. So I hope that that's clear. Let me do another invoice here in which I'm going to have non-taxable sales. So I'm going to pick a customer here, and then I'll pick an item. Let's do 10 taxable items. So I'm basically picking, like a standard widget. And then I'm also going to charge this client a non-taxable service of some sort. So I'm gonna select an item here called where is my service item? There you go, non-taxable service, and then this will be $10,000. Okay, so I basically have a $10,000 service and a $1,000 itemized product that I'm charging sales tax for. I have one item that's non-taxable, and then I have one item that's taxable. And then I select my state sales tax. In this case, if I happen to have multiple states, you have multiple things in there, and then that would be 6%. And then QuickBooks knows to only calculate the sales tax on the items that are marked taxable, in this case tax. So it won't charge sales tax on the whole thing. If I change this item, this service item, to a taxable sale, it will then calculate sales tax on the whole invoice. So I can individually choose which item is going to pay sales tax and which one is not, based on that drop down that is there. So I'm going to go ahead and click Save and Close. And we can go back and see this report. So now we notice that this report says total sales tax, non-taxable sales, taxable sales, and then the actual collected rate. So that the report would actually give you most of the information that you should see on the sales tax form itself. Now this report is defaulting at accrual because I'm going to go to the edit menu and click on preferences, and then I'm going to go into sales tax, and then I'm going to go into company preferences, because I told it that we do sales taxes on an accrual basis. Now, depending on the state, every state will have different rules. Some states force you to do it accrual. Some states allow you to do it cash, but want you to do it accrual. Some have a hybrid method that you must use. In Florida, it's accrual, by the way. So it doesn't matter whether you got paid or not. If you sold something, if it left your warehouse and you gave it to the client and it has a dollar amount associated with it, and you have a sales tax outstanding on that invoice, you owe that sales tax in the month that you sold it, not in the month that they pay you. So you can sit there all day long and do a cash basis report, but it's actually not legal. It's not allowed. And I am a Florida CPA, and I've been to sales tax audits, and I can tell you that with property. Now, when do you pay sales tax? You just tell it whether it's monthly or quarterly. So the reports accumulate quarterly. So I'm going to here, or monthly, whatever happens to be. So I'm going to leave this here monthly, and then I'm going to hit OK. Okay. And then if you are going to remit that sales tax, if you're going to make that sales tax payment, 672, what you want to do is go into the vendors menu, click on sales tax, and then click on pay sales tax. And you must use this form. If you do it some other way, like if you create a bill or write a check, you're going to screw up your entire process here. So you have to go to sales tax, pay sales tax, and then you select the date range in which you're gonna accumulate that sales tax liability. You're gonna select check mark on which state that you're paying. And in some cases, you may be paying multiple counties, but a single state, which in this case would be a single payment. And somebody's asking, what if you pay twice a year? So there isn't an option for that. There's only an option for quarterly, and there's also an option for monthly and annually, but there's no semi yearly. And I don't know if there was a state. Bob, is there a state? What state are you in? I didn't know there was a state that did it semi yearly. So that's kind of cool. Maine. Okay, I don't know about that. All right. So then in here you come, you do 372. Let's say, for example, the state is allowing you, it's giving you $30 of bonus, let's call it that, for collecting and paying that sales tax electronically, which is the case of Florida. Florida actually allows you to keep up to $30 of the sales tax based on some calculation if you remit and pay electronically. So you click on reduce sales tax by $30, like in this case, and then I have to have an income account called sales tax allowance. Okay, and this is actually income. Okay, so your company is actually making money by remitting sales tax electronically, and the state forgiving part of that sales tax and giving you an allowance on it. So you would have to be, I wonder if that's even spelled correctly. Okay, well, let's assume it is. And so sales tax allowance, you make it an other income account. You hit save and close. You put a dollar amount that the state is allowing you to reduce for that on-time payment or whatever. You put there $30. You click OK. Okay, and that will basically adjust your sales tax by the $30. So then when you go pay, the actual money coming out of your account will be the net of that. So now that would be $342. So then at this point, I hit OK, and then that creates my sales tax payment. Now, what you never want to do, ever want to do, is write a check, like this, Florida Department of Revenue, and then select here sales tax liability. You never want to do that. Like if you actually do this, you're gonna mess up your accounting. You're gonna mess up your sales tax tracking system. You're gonna mess up your sales tax liability. So you have to, the way to fix it is you have to delete whoever did it. You have to delete it and use the correct procedure, which you have to use that sales tax module to that. So when you're looking at the screen, it's how you should never pay your sales tax. You should always use the sales tax module for paying that sales tax. Okay, so let me go ahead and close that. So that takes care of that. And then once you go to the next month, so let's go now do this month. This month, and I have a completely different sales that I've done here. The sales tax payable shouldn't carry over because we created that payment somewhere in the middle of February. So then that should recalculate and then set up the new calculation. So what I've done here is I show you how I handle two tricky. So I show you basic sales tax. So at this point, hopefully that's enough for you to understand how sales tax works. It's a little bit more nuanced than that, but that's the basics. Now let's move on to the tricky sales tax transactions. So there's two real tricky sales tax transactions. One is Surtax and the other one is use tax. So I'm going to show you both. Let me close. Okay, I'll leave this window open. So let me go into customers, and I'm going to go to create invoice, and I'm going to show you one invoice. So the invoice you're looking at here is what I call, this is a setup. This is what the final product looks like. This is an invoice that contains surtax. Now, surtax is when the state has a statewide sales tax rate, but has a limited county or some sort of local additional sales tax that they charge, but they limit it to a certain dollar amount. In Florida, for example, if I am on Broward County, the famous Broward County, famous because I live here, the famous Broward County, there's no surtax, so you pay the standard Florida 6% sales tax rate. But if you go down to Miami, the sales tax rate goes up to 7%, so there's an additional 1% surtax. However, that surtax is only applied on the first $5,000 of the sale. So QuickBooks is actually not equipped to handle this type of situations. Like there's actually no easy way to do this. I actually had to do a lot of fancy, funky things to make this happen. So I'm going to go ahead and break it down for you step by step how we did this. So one is I have a couple of taxable items, right? So I can have two or multiple. And then what I have to do is I have to create a subtotal. So I created a subtotal item called total taxable sales. So I basically itemize all my products that are subject to sales tax. Then I did a subtotal for taxable sales. And then after I get my subtotal, which in this case is 100,000, then I add my regular Florida statewide sales tax rate itemized on the invoice. I no longer use it down here. So I no longer use it on the bottom, where it totals, because I can't use that anymore because I'm going to have some complexity in this transaction. So I basically create a sales tax item called itemized or non-taxable or something like that. I just call it itemized to avoid any confusion. Okay, so then we do that, and the invoice itself as a whole will not be calculating sales tax. Only the individual sales tax items under the items do that. Then what I've done is I'm going to go ahead and delete this. So then what I've done is I created a group. So I'm going to go into the item list, and I'm going to show you the group that I created. So I created this group called Surtax Calculation. And inside of my Surtax Calculation group, I have three items. I have one non-taxable item pointing to a sales account. It doesn't really matter what account you point it to. I have one taxable item pointing to the exact account as the other one. And then I have a sales tax item for the 1% right under it. Okay. Now let me break down what these items are. So we have my non-tax item used for sales tax. So I basically created a other charge that's non-tax item. I put a $5,000 dollar amount there, and I put in the description maximum of 5,000 or match the total sales. So I'm writing the description or how I want the QuickBooks user to behave or understand what this is. Okay. So then that's $5,000, and then I make that non-taxable. I can send that to any income account. It really doesn't matter what I send it to because I'm going to reverse it back. Okay. So that's the non-taxable item. Then I have my taxable item used for Surtax. Let me put them both here next to each other. So I have my taxable item used for Surtax, which is also another charge, but this one is the dollar amount is negative 100%. That way it basically mimics the dollar amount that's above it. That way it just basically matches. I send it to the exact same account that will reverse, but then I make this one taxable. Okay, and then I put here limit to the first 5,000, whatever. Okay, so then when I go back into my my group, I'm gonna see my non-taxable item first, and this is going to be a $5,000, right? A maximum. Then I have my my taxable item, which is going to be negative 100, and then we have my Miami-Dade surtax. So let's hit OK to see exactly how that functions. So let me go back, and I'm going to select now my group item, and you have to do it with group items because if not, you're going to sit there and do a whole bunch of work to make this work. So I got a group item here, and this will automatically insert all the items from me. It will insert the non-tax item used for surtax. It will insert the taxed item used for surtax, and then it will insert my my Miami-Dade surtax. Now, what this will do, and I know it feels really strange to have these functions, but what this will do is it will now calculate the $50 here. It will calculate $50, which is 1% of up to $5,000. Now, the only thing that the user has to do, that has to literally sit there and make sure they don't do it, is that if this sale doesn't go above $5,000, if the sales below $5,000, because that's the law in Florida, if the sales below $5,000, then I don't have to do any of this stuff. I would basically have a different sales tax item called, Miami-Dade sales tax for 7%, and then I would apply that, and that's it. I don't have to worry about it anymore. But the only reason why I'm doing this whole production is because I have a core sales tax rate, and then I have an additional sales tax rate. So that would actually correctly calculate only 1% on the first 5,000 and 6% on the rest. So I'm going to go ahead and hit save and close, and then I'm going to show you what this report looks like. Probably the most relevant piece of this is you have a whole bunch of pluses and minuses and all this craziness. At the end of the day, all I really sold was 100,000. So what I did on the way that I did it, it actually works perfectly. So this actually it gets to 100,000, and then it tells me how much is my non-taxable sale, which in this case is false. So the only piece that I ignore when I do this process is that I basically completely ignore non-taxable sales and taxable sales, and I basically reverse calculate my tax collected from there. So that's the only challenge that I have with Surtax, is I can't get that to report 100%. Okay, and somebody says, do you have to separate the 6% of the 1% for sales under $5,000? Ryan, so the answer is no. If the sales are under $5,000 in the case of Florida, I just have one sales tax item that's 7%. I don't have to break them down. Okay, now I only got about 3 minutes left until I have to get Avalara on to show us their software, which is pretty amazing, which doesn't it skips this whole all this crazy manual process in QuickBooks. I want to show you one more thing, which is actually a killer idea, because I see this question all the time, which is how do we handle use tax? Now, let me explain what use tax is. And again, I'm not a lawyer, so I'm not qualified to give you a full answer on that. But the way use tax works, or what use tax is when you purchase something from a different state, and that state didn't have jurisdiction to remit the sales tax for you because you live in a different state. You have the obligation to pay the sales tax rate in your state for out-of-state purchases, as if you had purchased them locally and pay the sales tax. So in other words, you have to out of pocket pay the sales tax equivalent of what it was if you had bought the product in your state. So can QuickBooks handle this? No, it absolutely cannot. Are there workarounds for it? Of course. It's QuickBooks Desktop. That's why I love QuickBooks Desktop, because I got the power of workarounds. And QuickBooks Online, try to do any of this stuff, and you're just not gonna have fun. You're not gonna be able to do this stuff. If you work with QuickBooks Online, you're gonna deal with a lot of manual stuff. Okay, so basically anything you purchase out of state or that you don't pay sales tax on, the state will probably require you to pay use tax, which is the equivalent of paying sales tax if you have bought it with sales tax. Okay, that's probably the best explanation I can think of explaining use tax without getting all lawyery. So this is how I do use tax. So after I make a purchase, so let's say for example I went and entered a bill, and then I went to Alaska Farms or something like that, and I purchased a $17,000 piece of equipment from them. So let's put here furniture and equipment, and that's $17,000. Okay, I'm not gonna pay them sales tax because they are making an out-of-state sale, so they're not gonna charge you sales tax. But then I have to remember that I have to now remit use tax. But we don't do it right away. We want to do it all together with our sales tax. So after you create the bill or the check, whatever it happens to be, what you do is you create a sales receipt. Now, I know this is gonna seem funky, but this is how you do it. You create a sales receipt, and then I use a customer, I call a use tax tracker. And then what I do, and you have to kind of follow along with this, what I do is I create an item called a use tax purchase, which I make taxable. But what I do is I create under the tax here, under the tax tab, I create a brand new sales tax code called use tax, right? Or something like that. Use tax, use, or whatever. So that's why I can call it FLU. So I know it's Florida use tax, assuming that I have nexus in multiple states. And then I make this one non-taxable in this case, and I enter the first one for 17,000. So that's the first thing I do, right? Because I'm basically imitating my purchase amount. Then I have another item called use tax 6%, which is an actual real sales tax item. So it's as if I am charging sales tax for this, which I'm actually paying it, I'm not charging it. And then and that automatically calculates the 6% on that. Then I subtotal it. Okay, I just do a regular subtotal. And then I have a new item called reverse use sales tax item. So I'm going to go ahead and edit it so you can see. So it's just a regular other charge called reverse use tax item. And then I make this negative 100%. And then I create an expense account called use tax on purchases. Okay, because it's actually an expense. Use tax is an expense. And then basically I enter that one after the subtotal, and the total automatically nets out to zero. But then internally, QuickBooks now added to my liability $1,020 to that. So by the way, I think, and I hate to talk about myself like this, but I think it's a genius approach, and I came up with this. So I had a client pay me like $2,000 to try every single possible way of doing this, and we spent like 2 months hitting every single button in QuickBooks until we came up with this. So I like to thank that client for sponsoring that knowledge. And then what ends up happening is when you go to this report, you're actually going to have the two things segregated. You're going to have your regular sales being reported on the top and your sales tax collected being reported on the top. And then I have a different vendor altogether called Florida Use Tax that actually tracks my liability having to do with use tax.